आखिर विशाल कॉरपोरेट कंपनियां रातों रात ताश के पत्तों की तरह क्यों ढह जाती हैं, जैसे अचानक उन्हें कोई दिल का दौरा पड़ा हो? But the reality of corporate death is far less sudden. Long before a company formally files for bankruptcy, a slow, highly detectable financial disease has already taken hold of its operations. When the infection finally runs its course, the law forces one of two outcomes. Chapter 7, where the business is completely liquidated and sold off for parts, or Chapter 11, a desperate attempt to restructure crippling debt and stay alive. When the final blow lands, employees lose their livelihoods, suppliers face unpaid invoices, and retail investors watch their portfolios evaporate. They are caught completely off guard because they do not know how to look for the early symptoms. By reading the leading indicators hidden inside a balance sheet, a company's demise can be mathematically predicted long before the final collapse. The autopsy begins with the most immediate test of survival: liquidity. This balance scale visualizes liquidity ratios, a strict mathematical comparison of immediate assets like cash and inventory, weighed against the short-term obligations coming due within 12 months. The baseline metric here is the current ratio. If you divide those short-term assets by the short-term liabilities and the result dips below 1, the company is facing immediate financial starvation. A business might possess a brilliant engineering team and a massive addressable market, but if it cannot cover tomorrow's payroll or next week's rent, it dies instantly. Passing this test only guarantees survival for the weak. A firm can have enough cash to pay its current bills, appearing perfectly healthy on the surface, while remaining mathematically doomed in the long term. This is the illusion of liquidity. To understand if a business can survive the decade, we have to zoom out and examine solvency. Solvency analysis relies on a forensic metric called the equity multiplier. It exposes exactly how heavily leveraged a company's operations actually are. This visual equation calculates the multiplier by dividing a company's total assets by its total stockholder equity. Take Tom's Telephone Company as an example. If Tom has $1 million in total assets and his investors have put in $900,000 in equity, his multiplier is a highly conservative 1.11. But if Tom's debt slice expands to 90, this stage is measured by the interest coverage ratio, calculated by dividing operating profit by interest expense. It operates as the ultimate countdown clock to a Chapter 11 filing. A dropping ratio proves the enterprise is merely scraping by to pay the interest on its loans. It becomes mathematically impossible to pay down the actual principal. When General Motors filed for Chapter 11, the collapse was preceded by these exact warning signs. Unsteady, declining cash flows collided with billions of dollars in mounting debt, leaving the auto giant entirely unable to service its financial obligations. While liquidity math keeps lights on today, solvency math determines whether a company has the right to exist tomorrow. When a single company fails, investors lose money, but when highly leveraged financial institutions fail simultaneously, the entire global economy faces collapse. To prevent systemic contagion, international regulators enforce minimum capital requirements. The Basel III framework acts as the primary defense against global banking collapses. This framework mandates strict solvency ratios across borders. It forces banks to maintain massive capital reserves, enough equity to absorb punishing economic shocks without defaulting. A parallel framework, Solvency II, applies the exact same logic to the European insurance sector. It stress tests massive insurers to prevent a cascading global recession. Aakre kabhi jhoot nahi bolte. Numbers don't lie. A balance sheet is a survival map. Understanding the mechanics of liquidity and solvency is the only definitive way to read the warning signs, predict the future,